Everyone, this is Chris. It's Tuesday, October the 4th. Hard to believe. Hope all of you had a good summer. Labor Day's behind us, and now all we have to look forward to is the election. That's really simple, isn't it? But one thing I'll assure you today, I'm not going to talk politics any. I know everybody wanted to, and you're probably disappointed. But just as usual, we start off things with just the idea that we're not bulls or bears at Kimball Charting Solutions. You know, our intention is just to try to find opportunities. We believe that, you know, if you're bullish or bearish, it's a psychological state of mind, not a strategy. And so we're trying to stick, you know, with the power of the pattern, you know, to help us out, and along with sentiment indicators and things. Today, quickly, everybody, I want to kind of talk about are the markets ready to break out of the chute and really get off and on running, or are they possibly at a much higher place to where they could slip off of? So we're going to kind of address both of the issues, or not issues, but these patterns and opportunities, and hopefully have a little bit of fun today. And I just want to thank you, all for being here and being part of the call. And if it's recorded, I totally understand if you catch it at a different date, or if you just need something to listen to put you to sleep. You know, we've been known to do that part pretty well too. So I know it seems busy, but just to start off with, let's just kind of take a 30,000-foot view of the world. This isn't every stock index, in the world, but as you look at this on your own, to where you can pause and look at it longer if you care to. I'll go through this quickly, but just to kind of let you know, the labels of what the chart are in the upper left gray bar of each chart. So this is the Dow, the S&P, mid-cap 400, Russell, NASDAQ in the middle, and value line geometric. So in the States, we're looking at large and small, tech, and mid-cap, but kind of whether, oftentimes you probably looked at optical illusions. If you would just kind of look at my arrow in the very middle of the screen and stare at it for a little bit, you can just kind of see that all of these indices remain in long-term uptrends that started coming off the either 09 or 2010 lows. So they've got 5 or 6 years behind them, and these are well-established uptrends. We didn't cover the bottom row, but just to kind of go over that, just to make sure that you're aware of what these are. This is the DAX index in Germany, the FTSE in London, and France. And so if you just kind of look, France in the lower right is probably the weakest chart pattern of all of them, because France is below 2007 highs and also below last year's highs. But overall, the rising support was tested a couple of times, like a year ago, and also earlier this year. It's held, and now they're trying to, some of the major indices, not some of the smaller ones, the Russell can't say this, but the Dow and the S&P and the NASDAQ are, they're working on it, trying to reach all-time new highs. The NASDAQ is real close to it. You'll know that I will bring up the 2150 number. You can count on me talking about that, here in a little bit. But overall, the big picture is long-term monies from the global dashboards reports and slow money. The trend remains up, but some of these are still struggling with last year's highs. And I thought, just real quick, we're going to dig into the DAX close up in the following screens. But I thought it was kind of interesting that earlier this year we had the Brexit was common in the news. I'm not a person that's into trying to give reasons for things, but it's kind of interesting. At the time of the Brexit vote, if you'll remember, in the summer we were sharing that credit default swaps in Germany were as high, in other words, like the VIX index here, they were as high, expressing concerns a few months ago as they were in the 2009 financial crisis lows, and also 2011, which around the world was another fairly, was a higher low than 2009, but was a time of high fear levels. So it's kind of interesting if you look at this lower chart in the middle, the FTSE was hitting support, and now coming off Brexit, it's went from all the way from testing 6-year rising support to last year's high. So quality rallies taking place in London when, many people thought there could be, an implosion over there, or that was a popular talk. I didn't hear too many people talking in the summer that actually, the markets would be higher, but they have taken place there. So general consensus, slow money, things are still slowly shifting higher, testing last year's highs. This is the advanced decline line, common stock only. We often get a question, why common stock only? The NYSE index includes some closed-end funds and also some bond funds, and so I can't take any credit for it, but a couple of years ago some people found a way to strip out the closed-end and the bond funds so you could just see just the stocks only, so that's why we put that up there, the common stock only. But you see the trend is solidly continues to push higher, and up in the upper right-hand corner, the advanced decline is within a small percentage of an all-time high. So no negative macro messages coming from the 6-year rising trends or the advanced decline line here. Now we're going to dig in and go a little bit closer to look at the S&P monthly. Since March of 2015, we started sharing that if you took the 2007 highs in the S&P and the 2009 lows and applied Fibonacci, this distance, if you'd add just 61% of this entire space between the 2007 high and 9 low, that's where you come up with the 161 extension, that level was around 2150, and it had a chance to be a resistance point. And last year it fooled around with it for quite a bit of the time and then backed off around 10%. Now, I always think that the great question is, to anyone in technical analysis, is what constitutes a breakout. So oftentimes, like we talked about, the 2150 zone is important. You can see in the upper right the price of the S&P 2163. Now, I'm not saying that's the close today, but that's the market's close to that. So we're essentially still at resistance. The market did get, everybody, maybe 3-4% above the 2150 level, but I would never say it really had much that it could say that it succeeded in breaking out. It's not doing negative things, either. It does kind of interest me. Again, this is a monthly chart that 2 months in a row, you see those little plus signs up there, and those are called doji stars, where essentially the opening, which is the left side of the notch, and the right side, which makes the horizontal part of the plus sign, they're almost level with each other, and all that means is the last 2 months the S&P's gone nowhere. It's traded up and down, but its net monthly closing price action has been really quiet. So, let's think of it this way. This is, the trend is up. This is a breakout level that's being tested, but not enough buyers so far can just come forward to really push it a lot higher. But on the flip side, how about sellers? No, the market's actually, at that 2150 level, and the world can't find enough sellers to push it back below old resistance, which is now support. So we've had obviously a quiet 60 days. There's just a ton of indecision around the world at this key level. In time, this is going to be resolved, and if it breaks out to the upside, a lot of the world would be surprised. You don't hear too many people saying, sharing upside targets, nor or there's just an easy find projections from people of how great the market is, whether it's the political scene or whatever. But I find it really interesting to be within 2% of an all-time high, and how many people think things are pretty crappy. So it's just kind of an intriguing thing that's going on out there. All right. So I saw this cartoon, and from a slow money perspective, I was having a discussion with my wife last night about all-terrain vehicles, and we got winter coming up, and the roads will get slick, and the snow is snow, whether it's in Colorado or in Kansas or in the Northeast. But just because there's snow on the road doesn't mean that you can't go out and drive. It just means you ought to drive a little bit slower and maybe more defensively and a little cautiously. And so that's what we're doing with the slow money approach right now. We have a 50% exposure to the market, which means we're just driving a little bit slower. The risk exposure is less. I don't see a lot that's taking place to be concerning of a big market decline. There's not negative divergence that's taken place, but also there's a lack of buyers that seem to wanting to come forward so far. So we're going to discuss what could constitute the breakout and what could help the S&P get 2150 above that level in the coming slides. But right now, we don't see gobs of upside nor the downside right now until we can get this 2150 level resolved. We've talked for a couple of years about how important the DAX index, in our opinion, is. In 2014, the DAX just really outpaced the S&P. The S&P followed. Then early last year, once the DAX started showing weakness, so did indices around the world, which include the broad markets in the States. The DAX hit 6-year rising support, just like the S&P, and many indices in the States did earlier this year. So the way I look at this is DAX is in a long-term 6-year uptrend, and it has a series of about a year and a half, roughly 18 months of lower highs, constituted by this falling resistance line. So as you can see, it's a pennant pattern, frustrating both bulls and bears because you have a series of higher lows and lower highs. So it's trying to rectify, and it's a breakout test is going on, that if we'd wake up in the morning, weeks and weeks ahead, and you'd see that this DAX was breaking out, I would be surprised to see that the S&P didn't, wasn't following right along with it. So we continue to remain that the DAX, or of the opinion that the DAX is very important, and this is this is the biggest test it's had in a year and a half, because it's been up here, as everybody can see, multiple times. It's even been up here. This is a weekly chart, everybody. This is the 4th time it's testing this. And so this is a big test that's going on that's going to impact, I think, the risk on trade around the world with how it's resolved. Just a reminder, I've shared this several times in the weekly sector sentiment report. This is a historical, typical pattern analysis that seasonalcharts.com did that we've been sharing. But why I just keep kind of bringing it up is that historically in the election year, and as with a lot of years, October lows can take place and then a rally. This is a typical election year cycle. But essentially, if you were to get a repeat, I'm not going to invest solely on seasonally, but you can see on average around the 7th, first week of September is typically a peak, and about a month later is typically a low. So I just kind of wanted to share this right now, that we're about in that time frame that if history from a seasonal pattern was to take place, we would be close to a seasonal low with a push towards the end of the year. Speaking of October, this list is a premium member separately. But if you remember last month being the month of September, historically it wasn't an up month, and so when we did the search on average stock performance, there wasn't a lot of the stocks that had impressive 30-day returns on a given calendar month. This month looks a little healthier because I think it's kind of interesting. The bottom stock, again, just for those of you that are not familiar, we're looking back on data from 2006 to 2015. Going back over the decade, one of the filters is the stock has to be up 70% of the time, and then we're looking at its average and median return. So the lowest or the tallest of the 7 dwarfs, whatever, but the bottom rung is a positive 682. So if it seems strange it's in the red, all it's just reflecting out of this group, this is the lowest performer. But as we all know, that if any of us could capture almost a 7% return in a month, that would be nice returns. I'm going to send you the charts on these, but there's some nice returns and some good statistics that are taking place. If we would get a seasonal low and a couple of the other things that we're going to discuss on the crude oil markets coming up, some of these could have a chance to match or even outperform those. So we'll kind of give you some criteria of why, but we'll email you this list tomorrow, and I'm also going to send you some individual charts on some of these stocks that I like best. But I just kind of wanted to let you look at this list. We're at the 1st of October. I think I sent it a month ago, but I wanted to just kind of show it to you and share it again. I think the market's going to hinge on a couple of key issues, and I know it's not going to surprise you because I probably bored you to death with this, but this is an overlay of crude oil in the red and the New York Stock Exchange, which is a broader index than the S&P, and just kind of look at some of their commonalities. The red stripe, they don't all, as we all know, they don't always correlate, and even when markets do correlate for a period of time, sometime they're going to come to an end. And so at any time this correlation could end, but for whatever reason, from a little bit over a year ago, these two markets started correlating fairly tightly. You can see they peaked at the same time Here was a short-term low at the same time, another peak at the same time. Then they both double bottomed earlier this year at the same time and have rallied since. So we see some similarities on exact turn dates. You'll see we also see some similarities, excuse me, let me go back. We see some similarities of falling overhead resistance lines, and they're both very much pressing on the same thing. Doesn't matter about me being right or wrong, but I do believe that crude oil is very important on the world scene. Some countries use it as a currency to trade, and what it does can highly impact, I believe, a lot of other assets. We're going to dig into crude a little bit deeper, but the high correlation continues with resistance or breakout levels being tested by both of these key markets right now at the same time. So here's a look at crude oil only. Even we're going to discuss just in a second the inverse head and shoulders potential, but even if the inverse head and shoulders potential wasn't there, you see nothing more than a narrowing pennant pattern. That pennant patterns do what? They tend to frustrate, again, bulls and bears. People don't trade them a lot, but you do want to follow a breakout or a breakdown, so we have an important test. But this test to me becomes even more important because, you know, crude oil was, as you can see in the upper part of this chart, almost $115 a barrel in 2013, and then we reached on a couple of spike lows almost $25. So we've had a large decline, and so if there was a textbook potential from a reversal pattern, inverse head and shoulders, I'd have to give crude oil a high five. That so far you're following almost as good of a textbook pattern as you could. So we have a resistance test taking place here, which is the pennant. We have another one, which is the neckline at $50. And I think a lot of the risk on trade is going to depend on just what happens right here, folks, which is the $50 resistance level. I think if you want to see the world grow, I think you want to see a breakout take place, you know, here. If you favor the risk on trade in many assets, I think you want to see a breakout here. We'll discuss the potentialities of failures in upcoming slides right here. And I've got to say, you know, everybody, this is my 36th year, and you know, I don't have all answers, and I don't know of all circumstances going back. But I've not seen so many really intriguing reversal patterns taking place in some clusters as what I've seen, you know, in a long time. But what that means at a right shoulder is this is such an inflection point, folks. That's why I can't bang the drum loud enough at how big this could be. I did share in last week if you had a way to buy a long-term put and a call option on some of these things and you could sit back, this would be, I think, one of the best times to do that, because I think we're poised for some volatility that we haven't seen in a long time. Why I think the crude oil pattern is so important, you know, we started sharing in July when crude oil was at $50 that an inverse head and shoulders could be taking place, but the right shoulder was incomplete. We looked for a decline. It did from 50 down to 40, and now we're making, or crude oil is making another run to the neckline. So this pattern is not proven, but this is really where the rubber meets the road. Is, you know, the neckline is resistance, and this puppy's in a downtrend, everyone. And so crude is trying to see if it can break, you know, a downtrend. You'll notice the left shoulder and the right shoulder occurred at almost the same price. The distance between the left shoulder and the head and the right shoulder is almost identical. That's why I say this is really textbook. So no promises here, but why I just want to, you know, educate you on this. The measured move, which what you do is you take the distance from the head to the neckline, you then apply that distance to the neckline, and this is why this is such a big thing. It's an important asset. It's a big part of the overall indices, the S&P energy sector, that if this would be taken out, the measured move, and it wouldn't do it overnight, and we don't even know if it can improve the neckline break, but if it could, this pattern is suggesting if this pans out, that crude oil could rally on a minimal aspect up to $100 a barrel. And so it's roughly, you know, as you know, less than 50 now. It'd be a big move, 100% increase. The ripple effects and the impacts, if that would happen in crude, I think would be pretty big across the board. I'm not going into why that would happen, and yes, I'm well aware that we've got plenty of oil all over the world, and if this global economy would slow down, it's very hard to see why crude would go up. I understand all of those pieces, but if you didn't know what this chart was, you'd say big neckline test going on, that if it broke out, a lot of opportunity. This is not the same chart, but this is the oil and gas ETF XOP. You can see it has a very similar potential inverse head and shoulders pattern with a neckline test taking place. So now we have another play that could either succeed or fail at the neckline, right now. Here's the energy ETF. You can see a similar situation, going on, testing the neckline again, a potential reversal pattern after a multi-year decline. And keep in mind, out of all of the 9 S&P 500 sector, financials and energy are bringing up the rear over the last 5 years. And so it would be a real positive if energy, and we'll discuss it, if financials could get on board. And it would also be a negative if these lagging sectors would happen to fail here. So again, another ETF, potential reversal pattern, testing the neckline, which is resistance in a falling market, trying to see if it can change its trend. Emerging markets, as we know, a lot of those countries are impacted by oil prices and commodities. So there's a potential that EEM is creating an inverse head and shoulders, a reversal pattern after almost 5 years of lower highs and lower highs and lower lows. So it has a big test taking place, right now as well. Another big test. Sorry to put the label on there, but this is a Dow Jones Transportation Index, and you can see a potential inverse head and shoulders. Now again, inverse head and shoulders are typically trend reversal patterns. So if somebody made the case, well, Chris is really not in a long-term downtrend, I could say I can truly understand that perspective because it is in a 6-year uptrend. But this index did lose a pretty decent amount because it was trading at, 9,500, went down to 6,500. So that was roughly a 30% decline in transports. So it's potential that we have another inverse head and shoulders here with transports attempting to break out. So all of these have a chance that if they would pan out, would show some economic strength, which we have seen very little of on a global scale for the last several years. As we've seen commodities go down 5 years in a row. So one of the things we're going to discuss is what if these inverse head and shoulders reads are correct? If you're a bond player, would you start getting sweaty palms? Would you become nervous? So I think we'll also want to look at the bond market to see if it is showing any concerns on any strength in this sector as almost like a teeter-totter play. So again, potential inverse head and shoulders of transports, and it's testing this horizontal level. So one of the keys, to me, to success, right now for the markets and the risk-on trade is to try to see the broken banks get a little bit healthier. This is the bank, the BKX index, which is the bank index divided by the S&P and the ratio. And you can see from 2009, or coming into 2009, this thing was collapsing, which just reflected that banks were much weaker than the broad market in general. Had a rally, and then you see that banks were weaker again. We had a rally through 2014, and then since 2014, over 2 years, we've seen this gradually drift lower to where recently the ratio was at the level of the 2012 lows and getting very close to the level of the financial crisis lows. So these banks need to be acting healthier. I have made an investment or a bet, that we're long financials here and short bonds. And so that's not a play on the world becoming a bug on a windshield. That's a play on actually things getting a little bit better. It doesn't mean the play's correct or right, but that's what we're trying to do right now, is trying to look at the plays that have been beaten up really badly, and then you'll see shorting bonds that have done pretty darn well going into July of this year. So for the risk on trade to do better, you want to see this ratio continue to move higher, because for most of history, very few times has the stock market had a really great rally when banks weren't on board. This is another look at just the bank index only. You can see a massive pennant pattern going back a decade long. The bank index is a lot closer to resistance now than it is support, but this is maybe another reason for some of the choppiness in the market. They're just trying to see is can financials, get out of here and break out. So if we'd have a breakout of this pennant pattern to the upside, I'd be very surprised to see the stock market not doing well. If we'd see a breakdown, it'd probably be very tough for the S&P to do much above the 2150 level for a while. So again, keep your eye on the bank's important price points. I can't reiterate enough, I think, how important it is to, get outside. We have people on this call are from all over the world, but for the people in the States to continue to look at what's happening in Europe and Italy. But we got to ask the question, through all of this, did a potential triple bottom take place in two of the hardest hit financial places in on the entire planet? So on the left is European banks and on the right is Italian banks, and we can see that potentially this spring, both of these created a triple bottom over an extended period of time at the bottom of steep falling channels right here at this one arrow. These are not the same charts, but they do look a lot alike. We've seen a bounce since the Brexit in both of these, which has taken them up to falling resistance. So again, these are both in steep, they're in down trends, obviously, and they're testing to try to see if they could break out at 2. Strength here would be very, very good for the risk trade around the world. A failure here, if the S&P would show weakness at 2150, it would show that it would be a good idea not to have a lot of exposure to the risk-on trade. So we have, again, another of the hotbeds around the world at an inflection point that's going to be really key for people to determining portfolio construction going forward. Unless you lived in a cave, everybody probably was aware of, Deutsche Bank was really in the news last week. It's kind of surprising that it's in the news so much last week when this is a 14-year chart, and you can see it was at 140. Why did all of a sudden Deutsche Bank become really in the news when it had been declining for several years? But regardless of that, from a technical pattern perspective, last Thursday we shared this chart in the social media, and we didn't put a name on it, but Deutsche Bank had one of its largest single-day declines last, I believe, Wednesday or Thursday, and it also had its largest trading volume day in its history, and the next day was followed with like a 15% decline, or a 15% rally, excuse me, after the decline. Now, last Friday's action didn't prove anything. This thing is still, as you can see, in a major long-term downtrend. It is the largest bank in Europe, so I don't think it's something to overlook. But you can see a couple of long-term, now this is Deutsche Bank monthly, so this is really a lot of data, and each of these bars is an entire month. So near a couple of key support points. It has broken to new lows. It is lower than the financial crisis, which is not a positive from a price perspective. Obviously, the trend's down. So I would encourage people to even if you're not interested in trading DB, but just keep a close eye on it because it's important on the big picture. Kind of switching to interest rates and bonds now. We know that interest rates are low. Obviously, the question is, are they going to rally? I want you to just kind of look at this chart for a second. It's 35 years. Probably one of the prettiest or cleanest uptrends for a 35-year time period. I've shared this a few times. I personally and humbly don't get caught up in the news about Janet Yellen or the meetings of the Fed or any of that. I think everyone, if you really want a picture of the interest rate, just look at the price pattern of one of the most high-quality bonds on the planet, and you can see that it's continuing to go up. And that means interest rates are going down, and I don't see that changing, but I want to kind of zoom in a little bit. This is the same chart that we just looked at over 35 years, but now we're going to go from 35 years to 3. So you can see that the Bund is still in a solid uptrend. It is above what the 2015 last year's highs. It kind of went sideways for several months, and you'll see in one of the following charts We shorted government bonds in the States right about the time that the boon started chopping sideways. But from a long-term perspective, the interest rate trend is still down. The boon price is up. But if you do have a large number of long bond holdings, I wouldn't be sweating things at this time, but I would be really concerned if you see the boon break a 35-year rising channel. That would be when I would try to be doing something in bonds with your long bond holdings. So we're short bonds right now, but the boon would say nothing proven that that's the right trade to own. It's slightly working for us, but if this boon would break, I would really encourage people to short bonds if you haven't. This is a picture of TLT, one of the popular government bond ETFs in the States. And this is a somewhat long-term picture going back to 2006. We went and shorted TLT right here at what we felt was potentially triple resistance with momentum at one of the more overbought levels in the last decade. You can see it's now created a series of lower highs. So the next slide we're going to drill in and just look a little bit closer just over the last year and a half. But we shorted TLT up here in July, and again it hasn't made huge gains, but the price action is favorable for a short position so far. I just highlighted this red piece. This is a weekly chart. Obviously this is Tuesday, so we can't say a lot about this week, but last week stuck out to me that we'd seen a 2-week rally, and this is a large reversal pattern, or what you want to call a bearish wick in a series of declining highs. So obviously I have a bias being short bonds, but even if a person wasn't short, if you were long, this would be a concerning pattern that you wouldn't want to see bonds follow up with more weakness. So again, like today, one day doesn't make a trend, but the stock market was soft, but at the same time, I think TLT was down over 100 basis points today. So gold and silver were down. There wasn't a lot of places to hide in today's market. A lot more, obviously, a lot of assets correlated to the downside today. So right now, the big question to me is, especially from a commodities perspective, is this world about to get a lot stronger, or is the commodities complex about to become a bug on the windshield? And this is, to me, in my career, it's not a distinguished career by any stretch, but in 36 years, this is, I think, one of the more important price points that we've seen in a long time. So this is, on the left, a 50-year chart of the Thomson Reuters Commodities Index. So this would be a basket of all commodities. And we started sharing in July of 2014 that looked like we were at the right shoulder of one of the largest head and shoulder topping patterns that we've seen. So since that time, commodities have dropped sharply. Commodities are now down 5 years in a row. That's never happened in the history of commodities, not even during the Depression. So this isn't a funny aspect for the people in this industry. This is serious, and it's also, to me, an important macro picture because it does reflect demand or lack thereof of the basic staples of our lives around the world. So the trend is down, and I can't help but tell you how important, that there's 2 resistance lines that this counter trend rally is driven up to of recently. So if commodities are to have a chance to reverse the trend, they have to break out here. So from a bull or bear perspective, I want to just share, this is the trend on the left side. It's not being bearish, but this just is the trend, series of lower highs and lower lows for years. So this is a big test. So this is testing the downtrend. So I want to show you now the same chart looked at differently, that what if we're seeing a large trend reversal after a record 5 down years in a row. So again, this is the Thomson Reuters index going back to the mid-60s. This is the large decline that we've had here over the last 5 years. But what I did was, when you think of, what is a high or a low, it's nothing more than a collective gargantuan emotional point around the world of bulls and bears. And in 1980, we had this is a monthly chart, so it was an important peak in 1980. Then commodities fell for, 20 years. Then we had the commodities came down really hard into the financial crisis. And created a reversal and rallied. And so if you put those 2 points together, here was a low point earlier this year. So this chart on the right is now trying to make a bull case or a reversal case of this historic decline. So this was a support that was hit here, and so now we have a huge test that's taking place, which is the 23% fib retracement level, which is also this double resistance, right here. So however you feel about the central banks, you trust them, you don't trust them, they're doing the right thing or the wrong thing. They are trying to fuel this world, and it's not growing a lot. But this is a counter-trend growth test that's just a monster right here, folks. That I think, what happens at this price point, I think we could look back 1 to 2 years from now and say that was a doozy. That was a big opportunity there with what the world did with that. So this is the Aussie dollar. I continue to try to share this, if not every week, every couple of weeks. Obviously, it's a currency. It's a currency based upon a country that's very much heavy in commodities, and so it has a high correlation to commodities. There's a chance there's no chance that the trend is anything but down in the Aussie dollar, but we are seeing a small counter trend rally that could be an inverse head and shoulders with a big test of channel resistance taking place, right here. So if the world's to grow, to catch a bid, if crude oil is to do well, if the XLEs or the XOPs are doing well, the Aussie dollar needs to probably do the same. And so this is a big downtrend test that's taking place, and that's why I say it's amazing to me how many parallels there are in these look-alike patterns. Here's a Canadian dollar, which has a similar circumstance to the Aussie dollar, a country that's laden in commodities, collapsed over the last several years. Is it really pulling a reversal pattern? Is it doing that, or is this nothing more than a rally and a decline? The world does not want to see this to be a rally and a decline, I don't think, from a macro basis. But again, a lot of potential reversal patterns that are taking place on weekly charts that are taking weeks and weeks, some of them almost a year to potentially create, and now we're testing resistance, another big one. Look at this big one, Japanese yen, going back, 25 years. The yen had stayed in this blue rising channel, and then it broke it in 2014, and the yen collapsed. The yen we shared earlier this year that looked like it was forming an inverse head and shoulders. It's broke its neckline. It's just ripped just really fast. Now it's up against triple resistance here at 1, testing the other side. So we got a lot of currencies at really key inflection points. If you're a currency player, this would be a great place to be shorting the yen with a tight stop there at 1 in case it broke out. So another currency at a really key long-term important inflection point. A couple of assets that have really been slipping below resistance of late that caught my attention, and a lot of that happened today. This is a 40-year chart of silver. We've shared this numerous times. Silver is in a downtrend. This is the 61% retracement level at 1, plus 4 other resistance lines came into play. So this counter trend rally faced a 800-pound gorilla test, and so far it obviously has not succeeded in breaking out. This faint blue line, which is around the 1850 level, is now a huge support test. And this is a monthly chart, everyone. This isn't some short-term piece. This is really a long-term one that if you're long in silver, I'd be really, really careful here. If you're aggressive and silver breaks this level, it could head down from 18 back to the 15 level really quickly. So there'd be a percentage play that you can make a good bit of money on a short. So really critical. As you'll notice, these 2 prior lows became a high for silver. It did push through it, and now it's testing old resistance as new support in a downtrend. So this is a big one. This is gold. Gold weekly, and you can see a couple of weeks ago it broke the entire rally of this year. It broke a little bit below it. It kissed the underneath side. It tried to get back above it, and then it's faded hard. Obviously, the week is not over with, but you can see so far on the week, when I did this chart earlier today, gold's down almost $42 in the first 2 days of the week. Weekly momentum is still very lofty and turning down right below fib and 5-year falling channel resistance. So the trend remains long-term down, short-term it's up, and it's now breaking the 6-7 month rising channel support this week with strength. As we're getting near wrapping it up, you know that we've shared in the metals report consistently every week is a silver-gold ratio, that if you're long metals in the risk-on trade, you want to see silver outperforming gold, or in other words, the silver-gold ratio pushing higher. It did from earlier this year. It hit the 2014 highs. You'll kind of see this horizontal line. And then this week, the ratio is breaking down as gold is breaking support and silver at the same time. Well, silver in long term is not breaking support, but on the short term, over the last 7 or 8 months, all of these are breaking rising supports, which sends a very concerning message to the risk-on trade in the metals space. So in wrapping things up, the S&P continues to flirt with the 2150 level. Advanced decline line strong. Shoebox is not sending anything negative at that. No large-scale divergences are taking place. So there's a reason that this thing can break out to the upside. It can have some legs. We just got to see if the world can take some of these other pieces that have been laggers, being energy and banks, to come along, for the ride. With all of these inverse head and shoulders testing the neckline and the S&P at the 2150 level, this is, to me, a very rare price point that creates opportunity on the risk-on side, but it also creates opportunity on the risk-off side if we would happen to see failures in the energy and banking complex. This is not your average Fibonacci extension level, in my opinion. So with that, we're driving long. We still have the slow money at 50% exposure, but we're staying underweight because of these things. So I think so many things are going to hinge on can the commodities get strength, and can oil break out? Can we see some strength in those Canadian dollar and the Aussie dollar, just to see if the world can show a little bit of confidence. If that confidence does come into the market, if I was in the bond market, if oil continued to go up, if the commodities, watching copper and different things, showed strength, I could see bonds still weakening for a while. And obviously I have a bias being short right now, but short or long, I could see a little bit of concern if there would be some strength. Bonds have had it made. There's not been any strength concerns for quite a while, and I'm not saying we have them right now, but if we would, I could see some people sell some bonds. And then lastly, I can't tell you how important it is for these necklines to succeed, because these assets that are in downtrends, this is the biggest test, everybody, they've had in 5 years. This is the first time they've tested, just like silver and gold, tested 5-year resistance of late. And today's, or just the recent action doesn't prove that they've failed, but it just shows that they're still in those downtrends. And so you tend to want to sell rallies, sell into that strength. And so I do have a bias. I'd love to see commodities from just the collective world just do better. I'd love to see the commodities gain some strength, like Arnold in the lower left-hand shoulder or the left-hand corner, because I think there could be some real opportunities in that space. So again, for the risk-on trade to be the breakout that we see in the upper left, I really believe that you need to see crude and financials get their act together and do better, than they are right now. So I want to thank you for taking this time, today, or even recorded, for attending. And I really think that we're seeing some of the best opportunities for volatility coming up that we've seen, in a long time, and I don't think it's probably too far away. So blessings to all of you, and take care. Thanks again.